Before December 2025, Six's Cricket, operated by its parent company, Mother Club, was generating £10.5 million a year. It was a highly visible, profitable entertainment business built around one of the world's most popular sports. Then, without warning, the company collapsed. In December 2025, Mother Club entered administration. The original shareholders, who had funded the brand's rapid expansion, saw their equity completely wiped out. 2 months later, those exact same investors received an unexpected email. It looked like an olive branch, a second chance to salvage their lost investments. The message came from a man named Tim Bowden. He represented 2 entities, Vantage Capital and Aurora Leasing. He claimed that, as secured lenders, they had acquired the rights to the surviving, profitable parts of the business out of administration. Bowden's pitch was straightforward. His firms had saved the best locations. Now, they were inviting the original shareholders to buy into a new company, NewCo, by putting up £500,000 to cover working capital and get the venues running again. The offer presents a very clear conflict. The same lenders who claim to have saved the business are now asking their victims for a fresh cash injection to keep it running. Let's run a basic background check on these 2 lenders who claim to have saved the business. First, Aurora Leasing. According to the UK's corporate registry, Aurora was a legally dissolved entity at the exact moment it supposedly signed off on satisfying millions of pounds in debt. A dead company cannot authorize legal financial filings. Then there is Vantage Capital. Their commercial profile shows a credit limit of exactly £500, accompanied by a high-risk caution solvency warning. Digging into their filed accounts reveals why. Vantage Capital held a net equity of negative £32,189. They were, by definition, legally insolvent. Yet, in the February pitch, Bowden claims these exact 2 entities provided £4 million in secured loans to Mother Club. The negative equity and dissolved status suggest these entities exist not to provide capital, but to serve as intermediaries for a hostile extraction. To understand how insolvent companies execute a £10 million takeover, we have to look at their structure. The organizers use an obfuscation buffer, a series of nested shell companies designed specifically to hide who is actually pulling the strings. The structure begins on January 28, 2022, with the incorporation of a firm called Gents Holdings. That same day, Gents Holdings created a second layer, Kernel Investments. Shortly after, Gents changed its name to Popcorn Holdings. The registry number remained identical, masking the connection. Popcorn Holdings when registered as the controlling entity over Vantage Capital, the vehicle used for the takeover. This shells-on-shells architecture creates a legal firewall. If the lower-tier entities face legal scrutiny, the fallout is contained far away from the individuals sitting at the very top. Let's go back to the central claim in that February email, the assertion that Vantage and Aurora loaned £4 million to Mother Club. A major piece of that debt comes from a convertible loan note issued in July 2025. According to the contracts, Vantage Capital stepped in to underwrite a £2 million cash raise. We established Vantage was legally insolvent. Claiming they underwrote this debt is a mathematical impossibility. Comparing the 2 figures, on one side, Vantage's actual net worth of negative £32,000. On the other, the £2 million they supposedly provided. An entity cannot underwrite a loan 62 times its net worth. Internal shareholder updates show that the £2 million was actually intended to refinance an entity called BizCap. This company grew its loan book by £36 million in just 12 months, with its account signed by an auditor linked to a network of over 100 shell companies in the United States. By creating this artificial debt and registering it as a secured charge, the network ensured that when Mother Club inevitably entered administration, these lenders would be first in line to claim the assets, legally leapfrogging the original shareholders. The mechanism they used to extract the assets is called a credit bid. In insolvency, a secured creditor can use the debt they are owed as currency to buy the failing company's assets. Because Vantage and Aurora registered that £4 million loan as secured debt, administrators were legally obligated to prioritize them when the company went under. The lenders didn't actually write a check for the business. They simply wiped away the phantom debt they had engineered, and in exchange, walked away with physical ownership of the brand. They didn't take the failing parts of the company. They surgically extracted the highest performing locations, starting with the flagship site at London Bridge, along with the highly profitable sites in Manchester and Oxford, taking full control of a national footprint. Through the credit bid wash, they successfully acquired a multi-million-pound hospitality business without spending a single penny of real money on the purchase. Which brings us back to that February email. The new owners have the physical sites, but because they never actually injected real cash, they have no operating budget. So they ask the victims to fund a £700,000 working capital gap. If an investor agrees to this second chance, they enter a compromised share structure. New money buys standard ordinary shares. Meanwhile, the lenders hold preference shares, which they have assigned a value of £4 million. This chart shows the distribution waterfall of the new company. Even if the new venues churn a profit, the ordinary shareholders will not see a penny in returns until Vantage and Aurora have successfully extracted their £4 million first. The solicitation effectively asks the victims to fund the ongoing overhead of a business that has already been legally stripped from them. The UK's Serious Fraud Office and international investigators are now actively tracing the money. They are mapping the US-connected shell networks to determine exactly how the initial extraction was funded and who ultimately holds the strings.